Inflation is an economic phenomenon that, although common, has profound and often underestimated impacts. Recently, we have seen clear signs of an increase in inflation. It manifests itself in several ways, from the increase in production costs, such as steel and construction materials, to the perception of consumers who are willing to pay more for goods and services. This inflationary behavior is particularly notable in the construction sector, where costs are continually rising. The dynamics of inflation are complex. It is not just in response to rising wages, but also due to factors such as material shortages and disruption in supply chains. However, what we are seeing now is a kind of buying mania, where demand for products outstrips supply, leading to price increases that, in many cases, are readily accepted by consumers. Behind this scenario is an economy that, despite expectations of a slowdown due to the pandemic and other global factors, is booming. Companies that were uncertain about what would happen when they resumed operations are now facing demand that exceeds their delivery capabilities. This situation creates an environment where price increases are not only possible, but inevitable. However, inflation does not affect everyone equally. In some sectors, such as international air travel, demand is still pent up, but in other areas, such as retail and food, money is flowing more strongly than ever. This phenomenon also reveals the disparity between different economic groups. While some accumulate wealth and benefit from the inflationary scenario, others face substantial economic difficulties. The situation is even more complicated when we consider the economic policies in force. We are, in fact, in a cycle where fiscal and monetary policies are stimulating the economy in unprecedented ways. This is done through extremely low interest rates and massive injections of money into the economy, which, in the short term, bring a sense of prosperity, but in the long term can lead to severe inflationary consequences. The impact of these policies is visible in the bond market. Those who are investing in fixed income assets, such as government bonds, could face a significant loss of purchasing power in the future as inflation erodes the real value of these investments. It is an irony that while the government appears to be helping the population through expansionary policies, in reality, this help can be nullified by the inflationary impact. The best defense against inflation, like an invisible tax, especially affects those who rely on fixed incomes and who do not have the ability to adapt their earning power. The best protection against inflation, therefore, is not in fixed assets, but in personal and professional development. If you are a renowned surgeon, a lawyer, or a prominent journalist, your market value will continue to grow regardless of the value of the currency. The second best defense against inflation is to invest in large companies that have pricing power. Companies like Coca-Cola, which have strong brands and a loyal customer base, can pass on the costs of inflation to their consumers without losing market share. These businesses have the ability to resist inflationary pressures as their products are essential or highly desirable, thus ensuring a steady flow of revenue. On the other hand, companies that rely on high capital investments are more vulnerable to inflation as their operating costs increase, while their ability to pass these costs on to consumers may be limited. Therefore, it is crucial for investors to choose companies with low capital requirements and high pricing power. Investing in yourself, the safest strategy. Regardless of the economic scenario, the safest investment anyone can make is in themselves. Developing your skills, improving your knowledge, and becoming an expert in your field are guaranteed ways to protect your earning power against inflation. Enhanced talents are assets that cannot be devalued by inflation or any other economic force. Formal education, such as earning a college degree, is just one part of this process. Practical skills, such as the ability to communicate effectively or adapt to technological changes, are equally important. Courses like Dale Carnegie's, which focus on interpersonal skills, can be just as valuable as a traditional academic education, especially in a world where communication and persuasion are crucial to success. Additionally, it is essential to choose a career that you love. Working on something that brings you personal satisfaction not only increases your quality of life, but can also lead to greater professional achievements. Searching for a career that combines passion and skill is a process that can take time, but it is critical to ensuring that your work has value regardless of economic changes. Learning from mistakes, a perspective on investment decisions. In the world of investing, making mistakes is inevitable. However, the biggest mistakes are not necessarily those that result in direct financial losses, but rather missed opportunities, moments when you knew what you should do but hesitated. These omissions can be costly, especially when they involve investments that could have brought substantial returns. However, it is important not to let yourself be discouraged by past mistakes. The focus should be on continuous learning and applying those lessons to future decisions. The ability to think independently is crucial in this process. In a world where investment decisions are often influenced by market opinions and social pressure, being able to maintain a rational, grounded perspective can make all the difference. The importance of partnerships and the environment's success in business and investing depends not only on individual skills, but also on the partnerships that form along the way. Having a business partner who shares your vision and values, like Charlie Munger to Warren Buffett, can provide the support you need to make difficult decisions with confidence. Additionally, the environment you work in and the culture of the organization play important roles. Working in an environment that encourages independent thinking and innovation is essential to achieving success. Major investment decisions are rarely made by committees. They are the result of a clear vision and the courage to follow that vision, even if it goes against popular opinion. Rationality as a pillar of success. Rationality is the factor that differentiates investors who manage to achieve success from those who, despite having great potential, end up sabotaging themselves. IQ and talent are important, but without the ability to act rationally, these attributes can be wasted. Rational investors know how to identify their own limitations and understand the value of staying within their circle of competence. This circle need not be vast, but it should be clearly defined. Knowing what you're good at and focusing on it is the secret to maximizing the return on your investments and minimizing risks. Conclusion: the investment journey. The path to financial success is complex and full of challenges. Inflation, economic fluctuations, and market traps are just some of the obstacles investors face. However, with the right strategy, focusing on personal development, investing in solid companies, and maintaining a rational mindset, you can not only protect your wealth, but also grow it. Investing is a continuous journey of learning and adaptation. Understanding the economic environment, making informed choices, and being willing to adjust your strategies as necessary are the keys to successfully navigating this ever-changing terrain. And above all, investing in yourself is the safest decision you can make, ensuring that regardless of external circumstances, you will have the tools you need to thrive. Inflation is starting to rise, and its impact is becoming visible in several areas of the economy. We have seen a substantial increase in prices, which is creating an interesting scenario. There is an increase in the costs of construction materials, and particularly steel. This phenomenon is notable in several sectors, including home construction, where operating costs and prices are on the rise. A big part of the problem is that despite rising inflation, wages are not keeping pace with rising inflation. This means that while the prices of goods and services increase, people's purchasing power is not adjusting accordingly. In the construction sector, for example, costs are rising at an alarming rate, and purchasing steel for large industries like General Motors is becoming increasingly expensive. Inflation is putting significant pressure on costs, and although contracts can be signed for several years, the immediate impact of inflation is clear. Furthermore, the pandemic has caused a number of additional problems. Many businesses temporarily closed, and when they reopened, they faced challenges related to their supply chain and ability to meet demand. There was a period when people were willing to buy, but companies were unable to deliver the products. The situation was such that delays were piling up, and expectations that the situation would improve were soon dashed as inflation continued to rise and the economy slowly adjusted. A curious aspect is that even with prices rising and production costs increasing, many sectors continue to prosper. People have more money in their pockets than ever before, and are therefore willing to pay higher prices for products and services. However, this situation is not uniform. Some areas, such as international air travel, are struggling, while others are benefiting from the economic situation. The restaurant industry, for example, suffered greatly during the pandemic, but those that were able to adapt and offer delivery and takeout services were able to increase their sales. In contrast, the market for formal wear and suits is struggling as demand has fallen drastically. The impact of the pandemic and inflation is uneven and creates a complex scenario for companies and consumers. As inflation continues to rise, investors and analysts are wondering what the long-term consequences will be. There is a growing expectation that inflation will continue to rise and that politicians may decide to pay off debts with dollars that are worth less. This is a classic strategy for reducing the cost of external debt, but it also means that the future purchasing power of investments will be reduced. In the current context, many of the government bonds and bond investments are being paid for mainly by foreign investors, such as the Chinese. These investors may see a reduction in the purchasing power of their investments over time. While it is convenient to state that taxpayers are bearing the cost, in practice, many of the costs are passed on to outside investors who may not immediately notice the impact. The best protection against inflation is to invest in yourself. Developing your skills and maximizing your own earning power is the most effective way to protect yourself against currency devaluation. If you become the best in your profession, whether as a lawyer, doctor, or any other profession, you will secure a share of the economic product regardless of inflation or currency changes. Furthermore, investing in solid and long-lasting businesses can also be a good strategy. Powerful brands like Coca-Cola have an intrinsic value that does not depend on economic fluctuations. These brands can offer protection against inflation because they continue to attract consumers regardless of price changes. However, it is important to recognize that not all businesses are created equal. Businesses that require large capital investments may be more vulnerable to inflation. Therefore, the best approach is to invest in companies that have a strong brand and a business model that does not rely heavily on physical capital. Investing in yourself is always a solid strategy. If you strive to become an expert in your field, you will be better protected against economic fluctuations. If you are dedicated to improving your skills and becoming a leader in your field, you will be ensuring a more secure future regardless of economic conditions. The current economic scenario is fascinating and unprecedented. With the fiscal and monetary policies being implemented, we are seeing an increase in stock values and business growth. However, it is crucial to remember that every action has its consequences. Inflation may be an invisible tax, but investing in yourself and solid businesses may be the best defense against its consequences. The experience and wisdom accumulated over the years shows us that the best way to face inflation is to improve our skills and invest in assets that have lasting value. Economic history teaches us that despite currency fluctuations and economic crises, those who invest in their own growth and in solid companies tend to prosper in the long term. Finally, it's important to remember that even in times of uncertainty, the ability to learn, adapt, and grow is the key to success. By investing in your own development and seeking out opportunities that offer real value, you will be better prepared to face economic challenges and secure a stable and prosperous financial future. As the economic landscape evolves, it is crucial to recognize the changes that are occurring and how they may impact our financial and investment strategies. Inflation, which has been a growing concern, can create both challenges and opportunities. Therefore, it is essential to be aware of trends and adapt our approaches as necessary. Sectors that are thriving during inflation are often those that offer essential or high perceived value products and services. Companies that can adjust their prices without losing customers have a significant advantage. This includes sectors such as food, healthcare, and technology, where demand remains robust and consumers are willing to pay higher prices to ensure quality and innovation. However, inflation can also lead to a change in consumer behavior. As prices rise, consumers may become more cautious with their spending and prioritize essential items over non-essential products. This could impact companies that rely on luxury or high-cost products, requiring these companies to adapt to maintain their relevance in the market. Another factor to consider is monetary policy. Central banks can respond to inflation with interest rate adjustments, which can affect the cost of credit and investment returns. When interest rates rise, the cost of financing rises, which can negatively impact industries that rely on loans for growth and operations. On the other hand, investments that offer fixed returns may become more attractive depending on the level of interest rates. Additionally, volatility in financial markets can create opportunities for investors who are willing to take calculated risks. Carefully analyzing market trends and identifying companies and assets that are resilient to inflation can provide opportunities for growth. Investments in tangible assets, such as real estate and commodities, can serve as an effective hedge against currency devaluation. It is also important to consider diversification as a fundamental strategy to mitigate risks. Diversifying your investments across different asset classes and sectors can help reduce exposure to any particular risk and increase overall portfolio stability. Furthermore, maintaining an adequate emergency fund is essential to face periods of financial uncertainty. Meanwhile, technological advancement continues to shape the economic environment. Digitization and automation are transforming several sectors, creating new business opportunities and changes in work dynamics. Companies that can quickly adapt to these technological changes have a significant competitive advantage. Ultimately, continuous adaptation is the key to thriving in an ever-changing economic environment. Staying informed about economic trends, adjusting your financial strategies, and investing in your own development are crucial steps to ensuring a secure and successful financial future. The current scenario may be challenging, but with a well-planned and flexible approach, you can face these challenges and seize the opportunities that arise. In addition to economic trends and adjustments in investment strategies, it is also essential to be aware of regulatory and political changes that may influence the financial environment. Tax policies and government regulations can directly impact the way companies operate and how investments are structured. Understanding these changes can help you anticipate impacts and adjust your strategies accordingly. For example, Changes in tax laws can affect company profitability and investment structure. Tracking proposed tax and regulatory reforms can provide valuable insights into how to plan your finances and maximize benefits. In some cases, this may mean taking advantage of tax incentives or adjusting your asset allocation to minimize your tax burden. Financial innovation also plays an important role in a changing economic environment. The emergence of new financial technologies such as blockchain and cryptocurrencies is creating new opportunities and challenges. Integrating these innovations into your financial strategies can offer competitive advantages and new avenues for growth. However, it is important to be aware of the associated risks and ensure that these innovations are aligned with your financial objectives and risk profile. Financial education remains a powerful tool for navigating a dynamic economic environment. Investing time and resources in improving your knowledge about personal finances, investments, and risk management strategies can provide a solid foundation for making informed and effective decisions. Additionally, seeking professional financial advice can offer additional perspectives and assist in creating an adaptive and robust strategy. As the economy continues to evolve, the ability to adapt and innovate will be a crucial differentiator. Closely monitoring economic, regulatory, and technological trends, along with a flexible and informed approach, can help address challenges and seize opportunities as they arise. With strategic planning and a proactive vision, you can build a solid path to financial success and long-term prosperity. To develop a comprehensive strategic vision that allows you to thrive in an ever-changing economic environment, it is essential to consider several interconnected factors. Adaptation and innovation are crucial to staying competitive and ensuring financial stability amid market fluctuations. Here are some in-depth considerations and strategies for meeting the challenges and taking advantage of today's economic opportunities. Analysis and adjustment of investment strategies. Firstly, continuous analysis of economic trends and adaptation of investment strategies are essential. In a scenario of inflation and variable interest rates, it is vital to adjust your asset allocation to balance risk and return. Diversifying investments can protect against volatility and optimize growth. Investments in sectors that have historically shown resilience in periods of high inflation, such as real estate and commodities, can be a way to preserve capital value. Additionally, considering hedging strategies can help mitigate risks associated with market fluctuations and economic changes. Derivatives, such as options and futures, can be used to protect investments against adverse movements, while protective assets such as gold and other precious metals can serve as stores of value during periods of economic instability. Impact of economic and regulatory policies. Tax and regulatory policies have a profound impact on the business environment and financial markets. Changes in monetary policy, such as adjustments in interest rates by the central bank, affect the cost of credit and, consequently, the behavior of investors and consumers. Monitoring monetary and fiscal policy decisions is crucial for predicting economic trends and adjusting your investment and financing strategies. Additionally, government regulations, such as changes in tax laws, can affect the financial structure and the profitability of companies. Tax reforms can create new opportunities, such as incentives for investment in certain sectors or regions, or they can increase the tax burden. Staying up to date with regulatory proposals and changes and seeking legal and financial advice can help you adapt your strategies and minimize negative impacts. Innovation and financial technology. Technological innovation is transforming the financial sector and creating new opportunities and challenges. The advancement of financial technologies such as blockchain and cryptocurrencies is redefining the concept of money and transactions. Companies are exploring these technologies to increase efficiency, reduce costs, and offer new products and services. Integrating these innovations into your financial strategies can provide competitive advantages and open new paths for growth. Blockchain-based smart contracts can automate and streamline financial processes, reducing the need for intermediaries and improving transparency. Likewise, cryptocurrencies are emerging as an alternative asset class that can diversify your portfolio and potentially offer high returns. However, it is crucial to evaluate the risks associated with these technologies, including volatility and regulatory issues, and ensure they are compatible with your risk profile and financial objectives. ###. Education and financial planning. Financial education is a powerful tool for facing the complexities of today's economic environment. Investing time in improving your knowledge about personal finances, investments, and risk management provides a solid foundation for making informed and strategic decisions. Understanding financial concepts such as the impact of interest rates, stock market dynamics, and tax planning strategies can improve your ability to plan and respond to economic changes. Additionally, working with a financial advisor can provide expert insights and help you develop an adaptive financial strategy. Consultants can provide detailed analysis, identify opportunities and risks, and help you create a plan that leverages your strengths and minimizes vulnerabilities. Proactivity and flexibility. The ability to adapt and innovate is a crucial differentiator in a dynamic economic environment. Continuously monitoring economic, regulatory, and technological trends and adjusting your strategies as needed can help you address challenges and seize opportunities. The proactive approach allows you to anticipate changes and make strategic decisions that position you ahead of the competition. In short, facing an ever-changing economic environment requires a comprehensive and well-informed approach. Adapting your investment strategies, understanding the impact of economic and regulatory policies, integrating technological innovations, and investing in financial education are essential steps to ensuring long-term prosperity and success. With strategic planning and a proactive vision, you can build a solid path to achieving your financial goals and taking advantage of opportunities that arise.